I'm Olivia Voznenko.
I'm Steve Guilfoyle. This is Street Smarts.
Did you guys see what happened today, Stephen?
Yeah,
Did you see what happened today?
Slash yesterday.
This is nasty.
4 or 5 days now, but Tuesday was the big one here in New York.
What are we pricing in?
All right, the markets have a lot to take in right now, and what I believe they are most pricing in is margin compression. All right, costs are going higher, labor costs are going higher, interest expenses going higher, material costs are going higher. We have nice revenue projections for the third quarter and for the fourth quarter, maybe 7.5% for the third, 6.5% for the fourth. Earnings are projected to be 19% year-over-year growth for the third, 17% for the fourth. So those numbers are fine. But this margin compression that we are now experiencing or expecting to experience, that was not priced in.
Okay, so margin compression, Sarge sounds so fancy right now. Basically, he's saying that stuff is more expensive for businesses.
And for you and I, but yeah. We got a CPI number today, which showed consumer level inflation not quite so hot, but these input costs, like you just mentioned, for businesses, they are a big deal. And what these corporations in their earnings calls want to put out to the people, that's going to be watched so much more closely than whether they beat numbers. That guidance is what's going to matter based on the tariffs and how they are adapting to such things like that.
Could it be that earnings won't even matter?
To some degree, I don't. If you miss by a mile,
I was testing you on that.
Were you?
He was going for that. All right, he's going for it.
If execution has been poor, of course that'll be noticed. But if you merely meet or just barely beat earnings projections, it's going to be a lot more about what a corporation says going forward, or if they're in a highly exposed industry to let's say China or some other country that we're currently not quite getting along with as far as trade goes.
And today we still have some voracious selling going into Friday. A lot of technicals going on. I know you said this doesn't really matter, but 200-day taken out.
It certainly matters to some. It's not one of my favorite indicators. What I notice and what I'm hoping means something, maybe by the time we're off the air it won't because markets have been moving quickly, but the S&P 500 caught itself around the 50% retracement from the sell-off way back in January, February, up to the high and back down. That was a 50% retracement and it caught there. It caught there and it saw a little bit of a push from that point on. And I noticed that Amazon, one of the high-flying names that's acting in accordance with the market here, acted the same way and caught itself at the same level. So I'm hoping that's the technical that matters.
And what other technicals are you looking at in specific stocks?
Oh, it's specific stocks. You know I like the pitchfork. I use it all the time. It pretty much tells you if a stock is staying on trend or not, and we have a lot of broken pitchforks. So you have to, once the pitchfork breaks, then you got to go to your Fibonacci levels. And I look for first the 38.2% level, but then we go to the 50 and 61.8.
When you say break, you mean fall through support on the pitchfork? Because there's three chances, right?
Right. There's two chambers, the upper chamber, the lower chamber. When we break through the lower chamber and a stock heads south, that's when I consider the pitchfork broken and I have to redo my entire technical analysis. This weekend, I will be up to my eyeballs in charts, probably downgrading a lot of my target prices.
Okay, so you like Verizon, you're into the cloud.
I do. Well, I've been buying the cloud the last few days. I bought Salesforce, I bought Adobe. These are names I've liked for a long time, and I was in them already, and they're still well above basis. So because I've owned them for a while, but I figured this was the chance of a lifetime.
But why? Why the cloud?
The cloud is the business of the future. Okay, yes, technology is where the future is, and it's also a CapEx for every other industry. But the cloud is, I believe, almost all data will eventually find its way to the cloud. I believe that's where the data center is going to be long term. This country is adapting to it a lot faster than the rest of the world, but the rest of the world is going to have to come along kicking and screaming. And firms like Adobe, like Salesforce, like ServiceNow, like Splunk, like Dropbox, like Zorro, these are the firms that I think will eventually be taken to much higher prices because of that.
And even though technology is breaking down, I don't know if you saw my Technical Tuesday, but it covered the technology ETF, XLK,
right,
which was in a bearish rising wedge, broke down with that. There's still a lot of room to go,
there could be. Right. That's the thing here. You do have to be a little brave to get involved here. You do have to wonder, is this far enough or is this not far enough? This is obviously a price where I would have wanted to buy it a couple weeks ago. So maybe you do things incrementally. That's how I solve this riddle. Okay, maybe I'll go in with a with 5 or 10% of my intended position size.
Yeah, do you mean dollar cost AVG?
To some degree, yes. I mean, but you can adjust that to the price. If it, let's say you're wrong by a mile when you enter, well, you might want to buy twice as much at a lower price when it comes your way. But I really firmly believe in never entering all at once or even in big chunks and never exiting the same way.
And you did that with Apple too. You got into Apple,
yeah.
which is 20% of XLK, by the way, and their earnings are coming up in November 1st.
Right. Apple's a name I took a big profit in back in the high 180s. And, you know, I've been sorry ever since because the stock kept going. I've made some money. I drove some revenue by selling some puts in the name, way out of the money puts that were trading at extended premiums at the time. So I didn't miss out on the rally completely, but I missed out on a lot of it because I wasn't an equity holder. So I took advantage of this huge sell-off. I started buying it yesterday. I bought more towards the close yesterday. I have not added to it today, but I'm looking to add it to it maybe when we get off the air, and I'll take another look. I also have added to Amazon yesterday and today, as well as those cloud names. And I started looking at General Dynamics too. General Dynamics is another interesting name because it's a submarine name. All right. Now, if the Chinese are going to cause trouble,
yeah,
the Navy is probably going to be the focus because we have the largest Navy in the world. It's how we extend our power globally. The Chinese have the second largest Navy in the world. GD has not been the beneficiary of a lot of these contracts the way the other names that I'm long are, like Raytheon, like Lockheed, like Northrop Grumman, like Boeing, a few of these. So I think GD, if the spending really goes towards the Navy because of China, and we head into another Cold War, I think this could be a beneficiary.
I like your brain. In the Navy, in the Navy.
boy.
I'm sure you don't want to hear that. All right, also, interest rates have definitely gripped fear in this market. We have to talk about the Fed.
Oh.
Where's your bat? Here's your metaphorical bat.
All right.
Go ahead.
Now, the president probably shouldn't be knocking the Fed publicly, but he's right. All right. In essence, he's right. The Fed took it a little too far. They've been too aggressive, I believe, on the trajectory of tightening interest rates and withdrawing liquidity from the balance sheet. I don't think they're in tune with the real economy because while the real economy does seem strong, we're past peak autos, we're past peak housing, we're past peak retail. There are signs of strength. Labor is still strong. Backlog orders are very strong for both services and manufacturing. There's still a lot to hang your hat on. Inventory building is still strong, but there are weak spots. And I think they have to be in tune to that. And we saw on that weak CPI number this morning that maybe they're being too aggressive here. Now, obviously they fear something. Otherwise, why would you raise interest rates every 2 months? And I just mentioned the balance sheet. Just last week, they drained $19 billion off of the balance sheet. That's aggressive. And you might need that potential liquidity somewhere down the road. You just don't know. I don't like doing both at the same time. I think the Fed should take a powder on interest rate hikes for at least a month. And you might want to know that on that data this morning, the odds of a hike in March dropped below 50%.
Really?
Yes.
Do you think they're setting themselves up for a recession? We've talked about this before.
Well, almost every recession in our nation's history has been caused by the central bank, or at least not our history, but since 1913.
Man, aren't they useful for, at least making history?
Since 1913 when they were founded anyway. But I do believe that policy error is one of the there are a few great risks, obviously. Obviously, a trade war that goes on for 20 years, like Jack Ma has suggested, would be a nasty thing. Sure. Obviously, the fiscal policies of our country are not perfect. I'm not just blaming the Fed here. The fiscal policies are rather irresponsible. Hey, I enjoyed the tax cuts as much as anybody, but as much as I hated tax and spend policies, it's also dangerous to have tax less and still spend policies. That's just something that at some point will weaken the long end of the curve, and it hasn't done it yet, but it should weaken the dollar unless every other country is even dirtier.
Yeah, and countries. Yeah. How about the IMF cutting global forecasts?
Well, thanks,
and
guys.
Will that spill over into the States?
Well, I think they actually had lowered the U.S. forecast, but I think the IMF just told us what we knew already. And they've always done that. The IMF has never been out in front on anything.
Yeah. Thanks, Dad.
We've been warning that probably the growth picture probably dried out in a year or two from where we started. So that would give us another 6 months to a year on this current surge that we've seen that has everyone in the country feeling a lot better about their situation. Growth will become a problem globally. Already China's in a hole.
Yeah.
Already Europe's not doing so great. Italy's a problem.
Italy's more than a problem.
Japan's not really so bad off, but they're not where they would like to be. They're not where we are.
So the question is that going to hurt the United States or can it help? Which I know you already told me, but let's tell our viewers, come on.
If our economy is humming and our markets are doing better, even if it's undeserved, if foreign economies are struggling, then foreign capital will flow into U.S. investments, and we will benefit from it, whether we deserve it or not. So there is that, and there is the matter of the corporate buyback blackout. So there are forces on our side. And for about 2 weeks now, there has been almost no buying of corporate repurchases in the marketplace. That takes away a bid. It takes away the artificially enforced scarcity of shares.
That's been really supporting us.
So we have about $1 trillion worth of corporate repurchases on the way. About 10% of that is Apple itself. If you're thinking of a good reason to buy a stock, there's one right there. I'm talking my own book now. But those are two big forces that I think really are on the side of the bullish investor, whether markets truly deserve it or not.
Man, all right, guys. Well, I think that definitely wraps up Street Smarts. Thanks for tuning in. Stephen, thanks for making your way in New York to, give us the good stuff.
Thanks for having me, Vaz.
Yeah, we'll see you next Street Smarts. Later.